comes Jeff Young.
Mr. Jeff Young,
Hi,
your
Jeff.
name keeps popping up this week.
Are you
You're on
talking?
mute.
You're on mute.
I said that's good, right? That my name's popping up.
Yeah.
See, so yeah. Hey, Brenda.
Hi, Jeff. How are you?
Good. Am I gonna see you Thursday?
This Thursday? I think so. Yeah.
You think so? You don't sound very excited.
Yeah, I'm excited. Yeah. Yeah, absolutely.
What part of
Yes.
town will you be coming from?
Seymour.
Where is Seymour?
On the way to Sevier County, Sevierville.
Oh no, that's a long drive for you. Are you out this way much on the west side?
What'd you say, Cedar Bluff?
Correct.
It's okay. I'm used to that.
Okay. Well,
Hi,
yeah.
Nathaniel. You're muted.
Hello.
Hey,
How
how are
are you?
you? Yeah. I haven't seen you in a while. It's good to see your face.
Thank you. It's good to see you as well. Yeah, we took a little bit of a work vacation down to Florida for a couple of weeks and looked at a few properties and relaxed a little bit. So yeah, we've been doing pretty good.
Good.
Good. Hello, Omar. Hello, other user, iPhone user.
Hello, hello. Sorry about that.
It's okay.
I'm in the airport, so I don't want to intrude.
Oh, no problem. No problem. So Jeff, I went to high school with someone whose name is Jeff Young. So
No
every
way.
time I hear you or I hear about you, I've always first I go back to him,
Uh-huh. Yeah.
and so I have to my brain has to shift.
I hear you.
Well,
I
maybe
totally hear
maybe
you.
it's him. Cindy, where'd you go to high school, Jeff?
Well, I
I
know what Jeff Young looks like. That's not him.
Well, I looked a lot different in high school, I promise
Yeah,
you.
people look different.
But yeah, I grew up in Dallas, Texas. So that's where most of my multifamily holdings still are, is in Dallas. But grew up in DFW area, lived in Portland, Oregon for quite a while, Barcelona, and then South Florida. So I was down in the Palm Beach area for 12 years, and then got up to this area about, I don't know, 2.5, 3 years ago.
Oh,
So
well,
a little bit everywhere.
I go to Dallas quite a bit. I work for a company called Note School with Eddie Speed. We invest in privately held mortgage notes.
Mm-hmm.
Dallas. So I go 2, 3, 4 times a year. I enjoy it.
Sorry.
I love the DFW area.
Yeah.
Yeah,
What do you
it's
like about it, Omar? What's your
well,
take on it?
I do a lot of remodels
Mm-hmm.
for Freddie Mac and Fannie, Freddie Fannie. So I'm up and down Texas, Abilene, San Angelo. I've got two jobs in San Angelo now. So Texas, I love Texas. It feeds me
Yeah.
well.
It's like the triangle between Austin, Houston, and
Yeah,
Dallas. It's just
yeah,
like it's it's all going to just grow together. It's amazing how many
absolutely.
people are moving there.
Yeah,
The absorption rate's really high on our multifamily stuff, even though there's so much new stuff coming on board. We saw occupancies drop a little bit in the past, I don't know, 18 months, but I mean, it's still like they're absorbing them as fast as they can build them there, which is great.
Omar, do you renovate after houses are bought back or got back from foreclosure?
yeah. So I do a lot of foreclosure rentals,
I see.
but they're literally very light renovations for the Freddie Mac program. But I also work with a lot of multifamilies and a lot of insurance carriers with fire. So I'm a fire specialist, and so all I do is fire restoration, and I do it across the country. So I'm in Akron, Ohio right now, Clifton, New Jersey, Torrance, California, and good old Arlington.
That's where you're
Good
heading
old
next.
Arlington.
Arlington,
Uh,
Texas. We've had some fire renovations done in that area too. It's in multifamily, you're sooner or later you're going to get one of those. So we've had those, and with the insurance that we carry, we always have nice coverage for the lost rentals, and then we come back to a brand new unit that we're able to up the rents on them. So thanks to you guys.
It's a total team effort.
Yeah.
Total team effort.
Brenda is selling a burn house now. Are you closing on it this week?
I hope so. It's a long story. It'll close this week or early next week.
Hook me up with the buyer, Brenda.
Selling it. I
I may be
will.
able, I may be able to offer um, some opportunities there with my buying power,
Okay.
at least with materials.
Okay. I will send him your way. Yeah. I just didn't have the heart to renovate it. I'm busy working with next level strategies and mortgages and just not in the renovating space right now. So I'm selling
Good for
it.
you. Good for you.
So we are waiting for Caleb to join. And any other people that come in. Try to get started about a couple minutes after 7.
Hey, Nathaniel. Your speaker's off, but what do you do?
Oh, hi, Jeff. Well, I am transitioning into the real estate investor space, and also looking at getting into commercial real estate as well as a realtor. So I'm here to absorb and learn as much as I can and meet people.
So what did you look at while you were in South Florida, or were you in Florida? Where were you?
So we were in Brevard, and man, it seems like almost everything there is for sale. There's a ton of supply there, and it looks, we did a lot of driving around, and there's tons of opportunity. It looks like that could be had just in residential space for flips, but you know Florida right now is leading in supply of the entire nation as far as residential is concerned. So flipping and as far as selling and not refinancing probably wouldn't be feasible at this point in time. But we looked at several value add multifamilies as well that were there. There's been there's like a tide change, it seems, where there's certain portions of that county are really starting to become revitalized, especially that's the heart of the Space Coast where NASA and SpaceX and everything is, and so there's lots of cash there, and so the historical side of Titusville saw some rough years for maybe 10 years or so, and we looked at a business there at the hardware store, which is, they call it the old hardware store, but it's actually a brewery on the bottom space, and then up top is a short-term rental with a large flat, and it has like a real neat industrial style, like restaurant style kitchen in it. So yeah, we were kicking around some ideas for that space, but nothing really came of that. I'm still talking to the broker as well. So yeah, but that's kind of what we were there doing.
I feel like that area is unlike a lot of Florida, where in 21, 22, 23, it just got overbuilt and they were overextending on debt. A lot of international investments were coming into the way south, like in Brevard versus Broward. So Broward is where Fort Lauderdale is. I mean, all of that got, I feel like, overdeveloped. Cap rates got down to, 4, 3.5, 3 on multifamily. I feel like the Treasure Coast and north, that Space Coast, is all, it didn't get overbuilt. So you're going to have good occupancies and you're going to find those values. I think it's a great area. It's just going to be a matter of getting your taxes and insurance, the quotes going forward right for your underwriting.
Right. That's the challenge, especially, being new to that area from Tennessee. So, we've talked to a few realtors while we were down there as well, just to get a feel for the area. And she enlightened me that, just because, you have homeowners insurance, you don't have flood insurance, and you don't have, wind insurance. That all of that is separate. So that was very enlightening.
Yes, indeed, for sure. Well, I do have a friend down there that runs, he's an attorney, and all he does is eviction notices. So if you ever end up buying down there and you need someone to kind of stay on top of your property, he's the guy to do it. So just, keep that in mind.
Okay, sure. Yeah, I
He's
definitely
based in
will.
Palm Beach, but covers the whole of Florida, even some outside of Florida.
Yeah,
Everybody, I think Caleb is on.
Hi, everybody.
Okay,
Hi.
Hi, Caleb.
Hi, Brenda. Thanks for having me.
Hey, Shalom.
Hey, everybody.
So we've got a good crew tonight. So Brenda, let's go ahead and get started.
Okay, welcome everybody to the call. Cindy and I are putting on this event through Next Level Strategies. Cindy is a CPA and worked in the banks for 15 years or so as commercial underwriter, and is now working in the private money lending space and real estate investing space full time. So she no longer works for the bank, she works for us and Next Level Strategies and herself.
Yes, and Brenda is crazy enough to partner up with me. She is a retired educator. She left the school system to work on her real estate portfolio. She has a pretty good portfolio, maybe not including the house that burned down a few months ago, but she's going to sell that one. She also, Brenda works with Eddie Speed in Note School, and she teaches mortgage note investing. And we do we have classes every month and teach different strategies of how to invest in non-traditional assets using your IRA or just cash that you have. So Brenda, can you tell more about Next Level Strategies?
Yeah, if you want to see us live, we're usually live in Knoxville on Clinton Highway at Master Services, and you can come to class. And we broadcast these classes on YouTube. We put the links to YouTube, Instagram, and Facebook in our chat. And we teach people, like Cindy said, how to invest in non-traditional ways with their self-directed IRA. So if you need some help deploying that capital out of your self-directed IRA, we can help with that. And we did that through Next Level Strategies, offering our co-lenders a healthy return on funding deals for fix and flips, typically for the investors that work with us, real estate investors. So today we're going to talk about syndications and learn more about investing in syndications. And we have somebody here to talk to us about that, and that's Caleb. And Cindy's going to tell us about Caleb.
Yeah. Caleb and I met through social media. I can't remember who sent who a Facebook message, but we connected and talked about how we could help each other and learn from each other. And Caleb has been in business since he was 18 years old. He worked for NK Development Group and worked in capital acquisitions in that company. He has a podcast now, From Trial to Triumph, that you should try to check out. And he right now is the founder of Red Sea Capital Group, which is a private real estate company that acquires large value add apartment buildings. And so he is here to help us learn about real estate syndications. Caleb.
Cindy, Brenda, thank you so much for having me. Thank you, everyone, for tuning in to this. Really excited. I actually haven't been on something like this for some time. I haven't been like a guest speaker on a podcast, and it's funny, I'm doing another one tomorrow. So it's kind of a back to back. I love these things. I love seeing new faces as well. So when Cindy extended the invitation, I was really excited to just educate people on investing in syndications, what to look out for, what's a good deal, what's a bad deal, what is syndication even, right? Kind of high level. I'm a teacher at heart. I praise God for that spiritual gift. So I have a presentation prepared. I love interaction. Love questions. I think if you guys do have questions, think it'd be best, Cindy, Brenda, tell me otherwise if you feel differently, but save them to the end. I'll probably talk about what I had planned to talk about for 20-ish minutes and then have Q&A. There'll be ways to reach out to me as well if you have further questions, but I think we will go ahead and dive in.
And as you're thinking of your questions, if you want to drop them in the chat when it occurs to you, then at the end I'll help bring up those questions, Caleb, and we can talk about them.
Beautiful. Thank you. Well, I am sharing my screen so we can get started. Cindy gave a quick background about myself, and I want to high level just tell my story. I've been investing for the last 8 years. I'm 27 today. So I started investing when I was 19. Cindy mentioned my first business was multi-level marketing. That's when I was 18. It was part of Amway. But I've been investing for 8 years, and I started in small multifamily. If anyone knows a house hack strategy, lived in a fourplex. I lived with one of my neighbors was a drug dealer. The guy behind me was a hoarder. Lived with roaches, lived with mice when I was 19, 20 years old. So young, single guy could do that at that time. Did that a few times. I flipped properties as well, all here in Phoenix, Arizona, which is where I'm based. And then I met some mentors a few years into my journey. That's when those mentors, they were apartment investors. And that's when I fell in love with the syndication model, which we're going to talk a bit about. At this point, we've acquired 6 apartment complexes, 1 retail facility. Those have spanned from Oklahoma, New Mexico, Nevada, and Arizona. And our most recent acquisition was 233 units in Vegas. That's a bit about me and my background story. Cindy also mentioned some other credentials, but jumping into this topic, which is what passive investors should look out for in syndications. So as an intro to syndications, obviously any investment is a risk. There's no guarantees when you are investing in something, be it stocks, be it notes, be it businesses, syndications, anything at all, even a flip as a private money lender, there's always risks. What syndication is, I'll start with that, is when essentially a group of investors, those are the active investors, or we call them general partners, the syndicators, find a consortium of investors for an acquisition of a property, and then they provide that group of investors with a return. That's essentially what a syndication is. So we're raising capital to acquire a property, and that is technically defined as a security. A security is when we take investor capital or investors invest with us and we give them a return. That is what a security is. Now, there are 2 people in a syndication. Of course, aside from debt and the seller, but when it comes to a syndication, there are general partners and limited partners. GPs, LPs is the acronym for that. The general partner could be considered the sponsor, operator, might be another word people might call it. Those are the active investors. So if you guys have flipped properties or you have owned rental properties, the general partner is essentially doing everything you're doing for your rental, right? You're finding the deal. The syndicator is raising capital from investors. If you own a rental, you're securing the loan. You might be either managing the property or you might be managing the property manager. So everything that you do for your rental, the general partner does for whatever asset they're acquiring or they're raising capital for. The limited partner is the passive investor. They're the ones that generally put up most of the funds to acquire the property, and they're the ones that receive the ROI, the return. As you can imagine, it's a lot more hands-off compared to the general partner. But the risk to the limited partner is just their capital. They aren't signing on the loan, nothing like that. The way you can have access to these type of offerings is either you You can find deals like this marketed. I could probably go on Google right now and search potential syndicated deals. Where can I find syndicated deals? And I'd probably find 50 like that. Another way is to build a relationship with somebody and invest in their deals. So that's the route I take. I'm not a mass marketed company. I do have a front facing company, which is Red Sea Capital Group, but I don't, not on any marketing platform where our offerings are listed. Now, the syndication process, there's two types of investors as limited partners. We have accredited investors or non-accredited investors. Sometimes you'll see that term for non-accredited investor as a sophisticated investor. Again, I guess the terminology doesn't necessarily matter all that much, but we got accredited investors and non-accredited investors. Now, if you're familiar with syndications, you probably heard that term accredited investor, and you might have thought, I can't take advantage of these type of deals because I'm not an accredited investor. We'll talk about what qualifies as an accredited investor or not. But here's why it matters if you're accredited or not accredited. To put a syndication together, it's a security. So typically, if you are offering a security to the public, you need to register with the SEC, the Security and Exchange Commission. Now, that process is very long and extensive. It's typically 18 months, sometimes maybe shorter, maybe a little bit longer, but around 18 months. For us to close one of these projects, it's typically a 90-day closing. So we can't go through that long, tedious process, and it's very capital intensive as well. So several years ago, a few exemptions were created. So the two most common are the 506B and the 506C. Now, the 506B is where investors do not need to be accredited. You can invest in a syndication as a non-accredited investor. However, there are some certain conditions that need to be met. For example, for me, I don't know. Let's pick a name on here. Let's find let's say Nathaniel, right? Nathaniel and I have not met before. It's the first time meeting him, and we do not have a pre-existing relationship. Okay. What would constitute a pre-existing relationship? There's no set defined rule, but Cindy and I, we've met 2-3 times. We have a pre-existing relationship. So for an investor that's not accredited to invest in this syndication, as a non-accredited investor, I need to have, as a syndicator, a pre-existing relationship with that investor. And they also need to understand the risks with that. That's a given. That's what some people constitute as a sophisticated investor if they understand the risks with investing, that they could lose everything. You also don't want to take anyone's last dollar. So if Grandma Lou invests her money with me, I better make sure it's not her last dollar. And that's just an ethical thing for me, frankly. I don't want to do that. 506C is whenever generally you see a mass marketed deal, it's a syndication, and they say you have to be an accredited investor. Those offerings, they can be mass marketed. However, to invest in one of those projects, you need to be accredited. And to qualify as an accredited investor, you can have there's 3 ways to do that, or the most common ways, and it's one of the 3. So you could have $1 million net worth, excluding your primary residence. If you're single, you could make $200,000 annually, and there's a reasonable expectation you'll make that the following year. If you're married, that number is $300,000 annually, annual income. Or you can have a professional license, like a Series 7, Series 65, Series 82. Those 3 things, if you have one of those, you constitute as an accredited investor. And typically with syndications, minimums range from $25,000 to $50,000. Sometimes you'll see with these accredited listings, minimums are 100 grand. Now, how does this all work, right? So we understand what syndications are. Now, what is more in depth, kind of the overall process? How would this look if, hey, I want to invest in a syndication? What would that even look like? So let's say, hypothetically, so Cindy and I have had that pre-existing relationship, and we have a 506B offering. Now, I would call Cindy and I would make her aware of that investment, right? Her and I have had a conversation. She has expressed interest in these type of offerings. So, okay, she is on my list now. Whenever we have a potential listing or a opportunity, I will give her a direct call. Usually we'll do just a blast email as well to get some more eyes on it. Then next steps is, let's say I call Cindy. I say, Cindy, we have an opportunity. Targeted ROI is 20% ROI. Is that something you're interested in learning more about? She says, Caleb, wow, perfect timing. I just sold a rental property. I have to put this money somewhere. What do you got? Tell me more. I say, okay, well, we've got a webinar in a week. I will send you the prospectus information, kind of like a PowerPoint presentation, but attend the webinar. That's where we will answer all your questions and go really in depth. She attends. Let's say she wants to invest. We'll send her, well, typically we have a investor portal. Investors can go on the portal, sign in, create an account. All the documents and agreements are right there. So you can, it's like DocuSign. You click a few buttons after reading the agreements, and then the funding instructions are right after that. Very easy, seamless. All communication is typically done through that portal. So we can send, if we have 50 investors, we can send emails in 10 minutes to all 50. Distributions will go through that portal as well. And then post investment, we have, it depends, of course, on the syndication, quarterly updates. Every year, you would expect to receive a K1. That's a tax document. And then distributions depending on the offering terms. So in that webinar, that's when they would share, this is maybe a ground up development. We aren't expecting any cash flow in the next 5 years, or it's a value add play and cash flow should be expected 6 months afterwards. Now, in a syndication, as a passive investor, we recently raised, our last deal was 233 units, and it was a fairly substantial raise. The two most asked questions from the investors that did actually invest were these: how is my money protected? What's in it for me? What's my return? What's the benefit for me? And so in the next few minutes, that's what I'm going to unpack, are those two questions. And how do you determine that as a potential passive investor? So how do you choose the right investment? And how do you choose the right syndicator to work with? Obviously, track record and experience. Maybe you can talk with some of their past investors. If it's their first deal, that might not necessarily be a red flag, but it does show some caution, and you will want to see someone on their team that has had some experience before, or maybe they've taken some education classes on how to put one of these projects together. Transparency and communication. That is one of the biggest things of an active syndicator that I hear from other investors that have invested with others, where the deal is going sideways and there's no communication whatsoever. Or I'll also hear the deal went sideways, but they have regular open communication. And maybe since the deal has even gone not according to plan, they've increased their communication. And that's a good sign. Not, of course, the deal going south, but the communication. Sometimes, guys, you just won't know the communication until after you invest. But that's a very important thing, is the communication. What role is the person playing that brought you the deal, that brought you this opportunity? Because there's generally multiple general partners. let's say on average 3 to 5. Now, in that, there's typically, I'd say, at least what's very common is there's a handful, maybe one or two, that have the most experience. They have the most net worth, liquidity, track record. That's them. And then there's sometimes a few other people that are assisting in smaller roles, and so they don't have as much influence over this project as the one or two leads. We call them the leads, or you might have heard sponsor, key principal. Those are all the same thing. So who you invest with, it's important to understand, are you the lead sponsor, or are you, it could be the person that's investor relations. Hey, we're just raising capital for this project. The real KP or the real sponsor is Omar, right? And so that's an important question to ask, because the lead is going to have the most influence. They're probably going to be making the most decisions for this property. They're going to be the one you at least want to have a connection with, have a conversation with. If the investor relations person was the one that brought you that opportunity. And then strengthen the team. That includes property management, construction, asset management. A friend of mine who I've invested with a few times, he's on a couple projects, syndications, as the GP, and they are going south. A couple of those deals are going sideways. The reason is because property management has just been dropping the ball. They've gone through 3, sometimes 4 different property management companies, and it just has not worked out. So a good question, at least I would ask, is how many deals do you already own in this market? Because if they've had success already, the projects they already own in that market have gone well, and if they have a property manager they've already worked with, they know, like, and trust, probably won't have that problem. It's not that you won't have that problem, but it's less likely you'll have that problem. Also, population. Whenever you're looking at a market, for example, I'm solely focused on Phoenix. I've been pretty spread out, but I've owned, again, like in the markets that I mentioned. And right now I'm laser focused, dialed in. Let's say if I brought an opportunity to Omar will want to ask me, what's the reason you like Phoenix? And then I should be able to tell him why I like the Phoenix market. A big thing is job growth, population growth. If jobs are moving there, that means people are moving there. Is it a landlord friendly state? Supply and demand demographics, meaning absorption. Now, if you haven't heard of that term before, what absorption is, that is based on how many people need apartment units and how many new units are coming online. So new developments, that number is tracked. And so depending on the absorption number, we'll show you, okay, is there an oversupply, meaning we have a lot of apartment units and not as many people? Because if that's the case, and if the syndicator is buying a property there, then you got to ask the question, okay, there's an absorption, a supply issue. There's a lot more product, a lot more new builds coming online. How will that affect this deal? Or how have you mitigated that risk whenever you've underwritten this deal? Like Austin, Texas right now is getting beat up. They had a ton of product, new builds coming online. And so vacancy has gone up, right? Substantially compared to what it was. And Austin used to be one of the hottest markets. I mean, when it came to growth, 20 plus rent growth, 20 plus percentage in rent growth, which is abnormal, very abnormal. Is the state business friendly? Economic drivers. For example, here in Phoenix, one of the major highways, they're expanding the highway because they're getting ready for all the influx of people, for new jobs coming. They're incentivizing new businesses starting their new business. Also, is it a buyer's or seller's market? If it's a buyer's market, are they overpaying? Some other things we want to look at is reasonable expense assumptions. These are more when it comes to underwriting. Now, if you haven't heard the term underwriting, when it comes to deals like this, That means it's an Excel model, and I'll show you guys what that underwriting is here in a second. But underwriting is plugging in the numbers, the financials of that deal, and then essentially saying, do the numbers make sense to acquire this property or not? That's the underwriting process, the financials. Proper reserves in place. Now with these, I actually want to show you some visuals. I'm a visual learner, and I want to show you what this cap rate sensitivity test actually is. So we're going to look at, this was our prior deal. This is a cap rate sensitivity analysis test. So we've created this for this investment. So this shows us we bought this property at a 5.5 cap. Now, if you aren't familiar with cap rates, this I think will help explain what that is. Cap rates are how commercial real estate is valued. As investors, as syndicators, what we want to do is we want to buy at a high cap rate, sell a low cap rate. Now, that might sound counterintuitive, but a higher cap rate means there's more cash flow typically. You're getting a better bang for your buck. So we want to buy at a high cap rate, sell at a low cap rate. So the sensitivity test shows an investor, if we sell at a 6.5 cap, which is what we projected, then based on the net operating income, that's how the commercial real estate's valued. Based on the NOI, at a 6.5 cap, we could sell the asset. We could project to sell it at 80 million, just north of 80 million. Now, if cap rates increase, value drops 3 million. And it also shows how that affect the overall return. We can see it affects it by a point, 1% for this AAR number. That's the annual rate of return. So for this deal, investors are projected to receive 22% on their money every year. That's including cash flow and the equity on the back end. As cap rates increase, the value drops, so that the return drops along with it. We can see, hey, what if the market goes really good? The let's say cap rates decrease compared to what we thought we could sell it for at that 6.5. If cap rates decrease, value goes up. So this can show the investor, okay, this is a sensitivity test. Oops. The interest rate, I'm going to stop my screen for a second because I'm going to pull up another document just to share with you guys that's really important. And it's going to be this interest sensitivity test. Okay. So this is an underwriting for an 84-unit apartment complex we had under contract. The details don't really matter, but what I want to show is how can we test what the interest rate is? Or how, based on what interest rate we expect to have, let's say if we have a refinance for this project, when we refinance, we have to assume, let's say if we're going to refinance in 3 years, what will the interest rate be in 3 years? We have to make that assumption. So, and we can change that when it comes to the underwriting. Now, I know this might be really in depth for some of you guys, and that's okay. I'll explain some things here in a sec, but this shows us, okay, I just changed the refinance at year 3, and let's just say this is going to be a year 6 sale. So this right here shows us refinance. These are the terms for the refinance. So if I'm a passive investor, I would say, hey, Mr. Syndicator, can you please send me the underwriting for this project? So I can just tweak some things. I can see what your projections are. And you typically want to receive that information within 24 hours. Again, there's that communication test. If they take 2 weeks to get back to you, and this is like the beginning of the relationship, you haven't even invested yet, red flag. So this is where we can test the interest rate. So let's say year 3 refinance, we can see, okay, these are the returns. IRR, internal rate of return, which is one metric we use, and I'll explain what that means in a minute. And then cash on cash return. So if we change the interest rate, let's say now our interest rate, let's say worst case scenario, let's say interest rates go up from today, 8%. How does that affect ROI? Let's see, let's go back. We were at 19.4. So if we assume an 8% interest rate, ROI drops 8.9%. Let's look at loan to value. Let's say something really bad happens, we can get 60% loan to value. How would that change that? 17.4% IRR. Okay. So that's how we can test and have the sensitivity test. A lot of people invested in projects, and I know syndicators that did these type of deals where they had lofty projections. They had unrealistic assumptions, and they expected, let's say, interest rates to always be 3% for the next 10 years. And, 5 years ago during COVID, 2020, 2021, interest rates were 3, 4%. So if they expected to have a refinance at year 3, and let's say they expected that refi to be a 4% interest rate, man, those numbers look really good. And let's say, oh my gosh, we can have an 80% loan to value. Wow, the ROA looks amazing, but that's unrealistic. So that's why, as the investor, we want to be able to stress test what that is, right? 4%. So that's one other thing we want to stress test. Next thing I'll show you in this underwriting is rent growth. That's another big one, because back in those days, in 2021, 2020, in Phoenix, I think maybe I'm getting the year wrong, but 2020, we had rent growth of like 26% average. Not realistic, not sustainable. The next year was 19%. Still not sustainable. Today, 3, 4 years later, it's in some places negative rent growth. So that's why the rent growth is so important, because if we expected to year over year have this high rent growth, let's say 10% rent growth, unrealistic. That's why, especially these things I'm telling you, the rent growth projection, cap rate sensitivity test, and also if there's a refinance, what the interest rate is and loan to value is of that refinance, what the projections are seriously important. Really, really, really important. Because we can see, okay, let's go to the summary. Okay, 21.49 AAR. If we change this to, let's say, we can see the delta. So this number right here is saying between year 3 and year 4, we're increasing rents on average $56 a unit. As an example, if we change that to 3, okay, 33. Let's say 1%, hardly going up at all. Now $11. How much does that kills the deal? Maybe not kills the deal, but look how drastic that ROI was. So if we had bought this deal, and let's say we expected 10%, deal looks incredible. That's why understanding the underwriting, you don't need to be a whiz at it, but just understanding these key metrics are really important. And guys, if you're really like trying to invest in your first syndication, talk to the syndicator and say, hey, Caleb, what's the cap rate sensitivity test, interest rate if there's a refinance sensitivity test, and then also rent growth? Like, can we hop on a quick 15-minute conversation? Or maybe on that webinar, you could ask that question. Hey, can you pull up the underwriting? Let's go through this. Hey, now's our time. Let's hop on a private call, take 15, 20 minutes and walk through that. Because as a syndicator, if one passive investor is asking that question, others probably are as well. And so I want to have as much assurancy as possible for those other passive investors. And also, if I've done my job as a syndicator, stress test this deal, then I shouldn't be timid or nervous about sharing these numbers. Because if I would have done my job right, I would have stress test this deal. So let's go back to the PowerPoint. And then I also would ask, what's the wild card in this play, Mr. Syndicator? What is that? Now we answer that first question. How is my money safe? We answered it through conservative underwriting, knowing the market, things like that. Now let's talk about what's in it for me as a passive investor. What is my ROI? So some of the different metrics we look at, like the annual ROI, year-over-year returns, we call that AAR, average annual return. That is a formula that includes cash flow and the equity appreciation on the back end, right? So, for example, let's say I'm going to give the investor 7% on their investment. So let's say they invest 100 grand every year. I'm going to give them $7,000 on their investment. That's 7%. But at the end of, let's say we own the property for 5 years. So at the end of that deal, at the 5 year mark, that's when I'm going to give them their 100 grand back. And uh, let's say to get that 20% rate of return over 5 years, that check size might be $160,000 when we sell. And so if you annualize it out year over year, comes to be around 20%. And those numbers might be off, but that's hypothetically how that might go. Internal rate of return. This reflects time value of money. This isn't as common, at least for if you're investing in your first syndication, IRR might not mean anything to you, and that's okay. This is more for people that invest in a lot of syndicated offerings like this because it's time value of money. What IRR is a very, 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 very complicated formula. Very complicated. You need an Excel formula to calculate it. But what it is how soon do I get my return back? That's essentially what it's measuring. For example, if let's pick another few lucky contenders. Let's say Jeff is one of them and Leslie's another one, right? So Jeff and Leslie are investing in these deals. And there's two deals. Jeff's deal is a 5 year hold, and he's going to give the investor the ROI at 5 years. But Leslie's deal, it's the same dollar amount, right? Kind of the same. Let's say Jeff's deal is going to give me 20 grand a year, and Leslie's deal is going to give me 20 grand a year. So 20% on my investment, right? Year over year. But Leslie's deal is going to give me, or the projection is to give me my money back in 3 years. So Jeff's IRR, right? The annual ROI, AAR number might be 20%, right? They're going to give me 20 grand a year. But the IRR will be lower for Jeff's because my money is with him longer. So my IRR with Jeff might be 20%. With Leslie, it might be 25% because I get my money back sooner, which tells me there's less risk. Cash on cash return, that's how much money at the end of the day, cash flow I'm going to give this investor. Tax benefits. This is what separates syndications from REITs. REITs, you don't own the real estate. With syndications, you do. REITs, you own shares of this corporation. With syndications, you actually own the real estate, which means you can participate in the tax benefits. And as a passive investor, you're completely passive, right? There's no trash, tenants, and toilets, which I always dreaded as a rental property owner. Now, cons, this is my last slide. Cons, things to be aware of. Not suitable for hands-on investors. I know an apartment complex owner here locally in Phoenix. I've known her for 5-6 years. And she owns like a 20-something unit in Texas. And so we were going to buy it. But I said, hey, do you want to invest in our passive deal? There's no tenants, completely passive. You get 20% on your money, or it's projected to receive 20% on your investment. And she says, Caleb, I'm just controlling. I don't want to do that type of deal. And that's okay. If that person's more controlling, they want to, have control of the deal, bring on tenants, find the opportunity, secure the financing, then something like this is not for that person that wants to be more hands-on. You must have confidence in the syndicator, property manager, and their overall team. Because you are betting on the jockey, not the horse. In this case, the jockey being the syndicator, the horse being the deal, right? A bad syndicator can make a good deal bad. A good syndicator can make a bad deal good. Now, that is all that I have for you. I saw some questions come through, but feel free to connect with me. There's my LinkedIn. I'll give Brenda and Sydney the this material as well. So you'll have the notes, but feel free to text that number, just connect, and our team will be in touch with you. And that's all I got, guys. But figured Brenda, Cindy, if we could open up for Q&A, unless you have other plans.
No, I've got you. I've got a question here. It says,
Yeah.
Rodivia, if I said that right.
Yeah.
I always love hearing you spitfire information. So 2 questions. With tariffs increasing material costs and labor flight stretching timelines, how are you currently securing and managing bids for your value add scopes, especially when LPs expect tight budgets and short holds?
It's a really good question. Really good question. And it's good to see you again, Rodivia. Is that we aren't what I've seen some people do is they go direct to the wholesaler, right? Because the property manager might go to Home Depot, right? Home Depot is a wholesaler, or at least they're the kind of third party middleman. So we want to go direct to the distributor of the material. That could be one way to cut cost. We haven't seen, there's been some change with the tariffs. So that just means as an underwriter, I'm just having more conservative underwriting. I'm expecting my budgets to be higher. Also means maybe the deals I'm looking for have less renovation requirements, right? That could be they're less, they need less materials. So those might be the deals that we would chase instead. But it hasn't. I'll be honest with you. I'll tell you, it hasn't affected us a great deal. There's been some changes, but hasn't been as drastic as some people say.
Okay, and also he said, and looking ahead, what specific strategies have actually helped you speed up value add execution while limiting investor pass-through costs, even as labor availability declines? And I would question, what is investor pass-through costs? I don't know what that is.
Yeah, yeah. Or David, if you're there, can you expand on that? If not, that's okay. Take a jab at it.
Yeah, I don't know what he means either.
So, not sure what pass-through costs are, but the way it's a good question, is it just means having a really good relationship with the property manager. The property manager can kill a deal. They can completely kill a deal. And that means if a property manager has contractors in-house, that's a bonus for us as active investors. Again, if the property managers have relationships with more of those distributors, that's also a bonus. But for us personally, we're having vertical integration out the gate. What that means is typically we would hire third-party property management out, but now we are the third property manager. So, meaning we're talking to tenants, we're signing leases, we're receiving those maintenance calls ourselves.
Gotcha. Jeff asked, what was your ingoing on actual cap rates on the recent purchase with your exit plan at 6.5? And Jeff, feel free to unmute yourself and ask that question.
It's a good question, Jeff.
Yeah, Caleb, you had shown the spreadsheet with the stress test. What was your on actuals going into that deal?
5.5.
5.5. Okay.
Yeah.
Like as you're looking forward, you're looking at cap rates expanding, not contracting.
Exactly.
And that's what I've seen in other deals where, hey, we're going in at 6, we're going to sell at 5.5. And that's, again, opportunistic and, a bit starry-eyed thinking they're going to go that route.
Exactly. Yeah, and exactly. It's very, very specific situation where that would make sense. Where if I'm a passive investor, where I would invest in that deal if it really, really, really made sense. Typically, again, you want to if we can underwrite a deal and the numbers make sense, where investors can get their ROI. If we have a lower entry and then a higher exit cap rate, that's what we look for on all of our deals.
And what was your occupancy level on that particular deal?
At acquisition, 92.
That's good.
And Chris wanted to know if he could get a copy of the worksheet.
Yeah, this one, or the underwriting.
The underwriting one where you were doing, I think the sensitivity where you changed the
Yeah,
cap?
I can send that to you. 100%. Let me make
So
a
if everybody could put their email address in the chat, if you'd like further information, if you'd like a copy of the spreadsheet, or just if you'd like more information about, I'm not wrapping it up. I'm just saying this while while
yeah,
I have
yeah.
the mic. But if you'd like more information from Caleb, Red Sea Capital, or Brenda and I, put your email down there.
Beautiful.
Jeff wanted to know, do you do in-house management?
Yep, that's vertical integration.
Yeah, because what we're seeing now is that when we're looking at deals, there's a more value add on the management side necessarily than the actual physical plant of what we're purchasing. So looking at a deal that, like you said, the jockey's just not riding that horse right. Having the right jockey hop on there, if you have in-house management, really makes a big difference on being able to control the expenses, make sure that you're, fighting those tax appraisals and doing everything you can to conserve dollars on, waste.
Absolutely. Yeah, absolutely. And it comes back to experience. You want someone that's experienced on your team, someone that's preferably boots on the ground. That always helps. If you guys know the name Ken McElroy, he talked to somebody that he was a very large investor, investing for 30 years. He invested in a deal, I think, in Ohio. He's based out of Phoenix. Somebody else invested in another deal in Ohio, but this investor, the other one, was having a terrible experience while Ken was having a great experience. So it wasn't the market. And so Ken asked the investor, why do you think that is? Why am I getting a or why are you getting a bad experience and I'm going to get a good experience? Because Ken invested as an LP with a group of guys that were boots on the ground. They knew that market. The other investor that invested passively in another deal with a different operator, guys were out of state. They were out of state. So because they knew there's tornadoes and hail and all the fun stuff that goes into that market. Again, not a requirement, but is a factor.
I
What
have
other
a
questions?
question.
Mhm.
So I was considering a syndication in May,
Mhm.
and so they were wrapping up their fundraising and they were trying to close at the end of May. So, when you're going to do an investment, you're holding your money out separate. Let's say you got $50,000 that you're holding, waiting for the syndication to start.
Yeah.
And how, and you want to place it as soon as possible, but you want to make a wise choice. But so can you tell me the timeline between when they're capital raising, when it actually happens, and then do they ever like not launch, and maybe your money's held up for 3 months and it doesn't go anywhere? Can you talk about that?
Yeah, that's a really, really, really great question because we experienced that with the property we acquired. It was a very large raise and it was a scatter portfolio, it was 12 properties, same seller. So what we ended up doing was we raised some funds. We closed half of the portfolio December 2023. We closed the other half in um, May of 2024. So sometimes those people that invest, let's say if we're saying we need funds in by Christmas, all right, the 25th of December. And if you invest in, say, November 20th, your money's sitting there for 12 months. So if that sometimes what's happened to even us, right? We have uh, people have invested with us. We have gone to close a deal and the deal fell through, right? That deal fell through because something with a seller, if that happens, we give the money back to the investor. And it's important to ask that question beforehand because you don't want, it's like, hey, if that deal closes and then the syndicator uses your money as a way to pay the attorney. I think that's wrong. I
Yeah.
don't even think I've ever heard that before. But you should ask a question. Ask a question on the front end. So yes, your money will be sitting there. At the same time, think about it's first come, first serve with our investors. Because if we have a cap, let's say we need to raise $3 million and we blast it out to our investors. And within a week, we have $3.5 million in the bank. I've got to send 500 back. And if anyone else wants to invest, I can't. Because if I need to raise $3 million, think if I raise 3.5 million, now there's more capital. I need to give more cash flow to, I need to give more ROI to, so it depletes everyone else's ROI. No one
Right.
wants that. So there is that. I guess I don't like the sales thing, but take advantage of it now, right? You have to invest now, secure your spot. Um, but I think, Cindy, to answer your question, it's asking the syndicator, what will happen if this doesn't fall through? And then invest, secure your spot.
Okay, thank you.
Yeah. Did I answer your question?
You did?
Good. Good.
So do those funds go into an interest accruing account? So like it's sitting there for a year as an investor, like, as an LP. Um, is there any return on that, even though you're not seeing the big returns that were forecasted? But is there something that's coming back, or is it just sitting neutral something?
Yeah, that's a good question. And it's not like an interest account, right? Where you invest, how this works is, let's say we find a property, we go under contract, we raise the funds, we close it, we use some of those funds for the down payment and maybe for repairs. And so we're going to spend that money as we go along. But for properties that we buy, they're all value add, they're cash flowing. That's what I buy, cash flowing deals. So that means you would share in the cash flow. It's not really like an interest. It's more of a projection, because there's a difference in equity and debt, right? Debt is interest rate. There's no appreciation gain. Equity is, depending on the structure. If I tell you, Nathaniel, I'm going to give you part of this cash flow, I'm going to receive some as well, but you get a bigger share. That would kind of be like your interest. It's technically not interest, it's cash flow. And then when we sell the asset, whenever that is, it's illiquid. I should have said that. It's an illiquid investment. It's not like a stock where you can get out, you can pull your money out tomorrow. To get your money out, we need to sell the property, which takes a long time. So that's when we sell the asset, the expectation would be that's when you receive the biggest bulk of your ROI. Like if you invested 100, we're going to give you some cash flow, but we sell, we're going to give you your 100 grand back plus a $60,000 check from the appreciation. Does that make sense?
Yes, yes, it does. I appreciate that. So, going kind of piggybacking back on, I guess, Cindy's questions where that mine originated from, where you know she has that money, and also where you said it happened to you, where it's like a year long, process. So you've already closed on the deal, and you'll receive cash flow from that. Um, is that what you're saying? So like, let's say an LP gives you the funds, but you haven't closed on it yet because you haven't acquired all of the funds yet. Is that other funds sitting in a trust account, or that was kind of
Okay, good
what I was
question.
getting
No,
at.
that's like a bank account. So we have an operating account, and that's where the funds are going into. It's not in like treasuries or anything like that. It's in a bank account, and if the deal doesn't close, then we're going to give the money back. And so it's not accruing interest, anything like that. Typically, that's like a 30 days, money sitting in the bank account for 30 days, and then we secure the loan and we close on it. And that's what we need, that money for the down payment.
Okay, makes a lot more sense. Thank you.
It's a great question.
I'd like to chime in and ask one question. Are there any syndications where it's all cash? Everybody just puts up the cash.
I haven't heard of that. I mean, I'm sure it can happen. I know some people that typically we will get debt because we can leverage that money, right? It's kind of like stocks. if I'm gonna have 100 grand, I'm gonna buy 100 grand of stocks. That's how many shares I can buy. With real estate, I can buy a $400,000 house with only the same 100 grand. So I can buy more, but I haven't heard of that. I have heard, I met one investor that him and his father, they were a very successful business. They have 10, 20, $30 million sitting around, and they buy really distressed assets that are brink of
Being condemned.
being condemned. Thank you. Yeah. They
And
turn them around and they hold them themselves and they buy it outright cash. That's a very one-off situation.
that's okay.
Where,
I just know some investors that don't believe in debt. You know,
right,
they're
right,
out and they want to
right.
pay.
I know some people, yeah, like that as well. It's more rare. Good question.
So Caleb, when you were talking, your point before last about how these are typically held for a longer period of time, 3 to 5 years. And when you and I first started talking, and I was talking about people with IRAs, how you can use your self-directed IRA to invest in syndications,
Hmm.
and the time horizon is not a big a deal for when you're holding it in your IRA, because if you're 30 years old, you can't use that money anyway until you're, retirement age, 59 and a half. So the 3 to 5 year syndication period is pretty ideal for IRA.
Right. Exactly. And several of our investors, I'd say at least 25% of our investors, maybe even more, 25 to 40% use their retirement accounts. Hmm. One thing I'll note is that to do that, it's it's a rare situation where someone can use their retirement accounts at their current employer. And Brenda, Cindy, you probably know all about that. You can educate these guys. It works probably 10, 50% of the time from what I've seen. It's more rare.
Yeah, typically you need to have one that's not through your employer or one from a previous employer. People change jobs a lot, so there's a lot of old employer IRAs sitting around that can be
Hmm.
used.
Absolutely. Absolutely. Now, I do have a meeting here, but I can maybe take one other question. Otherwise, you guys did have I'll share with these great ladies the webinar or the presentation that has my information in there, so you can ask me other questions offline. But any other questions, friends?
Yeah, we're going to put an email out tomorrow to everybody, sharing your contact information, Caleb. If anybody wants to reach you, they'll get an email tomorrow.
Great. Okay.
All
Thank
right.
you so much
Thanks,
again, Cindy and Brenda.
everybody.
Yeah, thank
So
you.
Yeah,
glad that we
thank
got
you.
to introduce Caleb to our NLS family and meet some of his family as well.
Hmm. Hmm. It's great seeing you, everybody. Hope you have a safe rest of your evening and God bless. Thanks for the opportunity.
Nice to
Thanks.
see you again, Kayla.
Thank you,
Thanks.
Caleb. Bye-bye.
Bye.